Hello everyone, my name is Advocate Daxter Aujla and I have a bachelor's in Sociology Social Services with JD LLB in law, and I'm right now pursuing my master's in law. Anyhow, we'll go over a rise in the mortgage rates, and as we all know that the housing in the last 2 years the housing market has been up by 40%. And the reason for that is from 2013 to 2022, the home prices were most up. And from 1998 till 2008, when we saw the housing bubble, the home prices were not too high. And the reason for that, again, now I will go, is because of supply and demand. Especially here in Silicon Valley, Northern California, the supply is less, but the demand is more. Here, let's say the average rent for a two-bedroom is around $1,800 to $2,000, but here it can be much more than that. And again, average home buyer has less equity in their houses, because now what we are seeing is fall in the housing prices from 15% to 20%. So now they have less equity, but then we can also say that most of the people, they bought their homes prior to 2021, 22, so they are quite comfortable with their 5% mortgage interest rates. And now let's go to the banking part, the banking aspect of a mortgage. Basically, what we think is that the bank owns our mortgage, but the bank does not own our mortgage. The bank buys our mortgage, then it sells our loan or your loan to Freddie Mae and Freddie Mac. Now these two are government agencies that take the loan from the bank. They say, okay, we will buy the mortgage. And government is not a profit entity, so it is backed by, again, people's taxes. So at the end, the government is backed by the people, because we, you, me, everyone pays their taxes. So the government is for the people, of the people, by the people. Now let's go on to the third chapter, the third part of our presentation here. Let's see, we get a 425,000 loan, and the interest rate is 3%. Okay, and then our down payment is 85,000 down, and again it's a 30-year term. The principal and interest on that loan will be $1,433, the property tax $280, and then the homeowner's insurance comes to $66. So the total payment comes to $1,779. Again, the same loan, $425,000 loan with the interest rate of 6.75%, 85,000 down, 30-year mortgage. Then again, the principal and interest will be $2,205 with property tax of $280, and then the homeowner's insurance comes to $66. So the grand total comes to $2,551. So you see the difference, same house, same everything, 3% interest, you're paying a mortgage of $1,779, and here at 6.75%, you're paying a mortgage of $2,551. Now, since 2021, the Fed has increased the interest rate. It's gone up from 2.5, 2.7% to 7%, what we are seeing now. 2020, it was 3.9, 2019, it was again, 3.1, 2020, 3.9 at 2019. So what we are seeing is like an increase in the interest rate. And the reason for that is the banks want, the federal bank wants the interest rate to rise up because they want to control the inflation. Now the inflation, is extremely high, and that's one of the reasons, the interest rates have gone up. Now let's look at the adjustable mortgage. Let's say, the bank gives you the mortgage at 5%, and the market rate for the mortgage is 7% right now. So down 5 years down the line, let's say the mortgage goes to 9%. So your mortgage rate increases to 9%. From 5%, there's a steep jump of 9%. Or let's say, the Fed cuts the interest rate and it goes down to 3%. So that is your choice, that decision is up to you. And that adjustable rate, was seen in 2008 when the mortgage rate was around 4.75%. It went up to 6 or 3%. People had zero down, zero assets and no job, but they were easily able to secure a mortgage, and the rest, when the mortgages went up, they were unable to pay, so there was a housing crash. And everybody needs a roof. Some people rent, some people get a mortgage. Even if we get a mortgage, the bank owns the property, we don't. So the decision is ours. So this is pretty much the conclusion of my presentation. Thank you.